All right, everybody, now we're going to talk about Chapter 33, Interest Rates, Monetary Policy. So this is kind of the end of what you guys have sort of come to understand. It's going to be where we really get into how the Fed actually does its buying and selling of bonds. So remember that the interest rate is the price paid to use money. So that's nothing new. That's what we're looking at, price paid for using money. There are lots of different interest rates, though we sort of pretend like there's one. And we know that money supply and money demand are going to be largely what determines interest rates. So why do we want money? Well, there's two different ways, or two different reasons rather. So there's transactions demand, and this is going to be the money that we demand because we want to buy things. So nominal GDP is going to determine how much money the macroeconomy needs to hold. We need to hold money in order to buy things. So if nominal GDP is higher, we need to hold more money to buy more things, well, to buy the same amount of things at different nominal levels of GDP. The other reason that we hold money is as a store of value, and this is going well. I should have said up here in terms of transaction demand, how much we hold in order to buy things is independent of the interest rate. It just doesn't matter for what the interest rates are. We don't go to the grocery store based on interest rates. We go to the grocery store based on how much food we're going to buy. Right now, asset demand is a little bit different. When we are using money to store up value, to save, basically, when interest rates are high, then we're going to have a different incentive to save than when interest rates are low. So high interest rates, we will store less money, as we will have less money. When interest rates are low, we will hold more money. So basically, we will put our money into a bank. If we can get a high interest rate, we will hold very little. But when we're not going to get anything by putting it in a bank, we might as well just keep it ourselves. We might as well hold it ourselves, put it under the mattress, keep it in our wallet, whatever. We add these two together, our transaction demand and our asset demand, in order to come up with our total money demand. So here's what it looks like graphically. So our asset demand is independent of interest rate. So whenever we have a vertical line, we know that means independent of whatever is over here, in this case, the interest rate. Our asset demand is downsloping. It varies inversely with the interest rates. So when interest rates are low, our demand to hold money is high. And then we just add those two vertically. Add them horizontally. So at interest rate of, say, 7.5, we will hold 100. Okay, because it's independent. At interest rate 7.5 here, we will hold 50. Okay, so let's do it again now. At 5, I'd like you guys to do this. So pause and do it. How much money will we hold? Well, we would hold 100 again because it's independent. And then at interest rate 5, we would hold 100 here. And sure enough, we see that here we are drawing our line at 200. Okay, so at interest rate 5, we are at 200 here. Now notice that the supply of money is vertical, and it is vertical because you'll recall that the Fed decides how big the money supply ought to be. And we'll talk a little more about the mechanics of that in a bit. So our equilibrium interest rate is going to change based on supply and demand. So you'll recall that we have a vertical money supply, and as the Fed changes it, it'll move left or right. And then our downsloping money demand curve could also move right or left. Now, bond prices and interest rates are going to be inversely related. Basically, since bonds pay fixed interest payments, lower bond prices are going to raise the interest rates. So basically, if bond prices are low, then people are going to desire higher interest rates elsewhere, and that's going to push interest rates up. Okay, so let's imagine again that we have our T account, and we know that in banks, securities and loans become the assets. So things that they own, government securities, cash, that sort of stuff, and then loans that they have already made are going to be the assets for the Fed. And the liabilities for the Fed are going to be what they owe commercial banks, any deposits that they have for the Treasury, and then old notes that they have outstanding. Okay, so here is an example. It's not terribly useful because it's pretty outdated. But what I'd like you to basically understand is just this idea that they have assets and liabilities, which gives a net worth. Nothing real shocking there. Okay, so open market operations. This is the tool of monetary policy that we're going to spend the most time on. So open market operations, this is conducted by the FOMC, right? So remember, we're talking about the FOMC, the Federal Open Market Committee. They're the ones who do open market operations. And when we say that, we're talking about the buying and selling of government securities. Okay, their customers are both commercial banks and the general public, you and I, and they influence the money supply by doing this. Now, basically, this was you guys know all about what interest rates currently are because it's changed in the last little bit and you've done some work on them. But if you clicked on this, it would take you to the historic rates that we've had for a long time. You could click that if you wanted to on your own time. All right, now when the Fed sells securities, commercial banks' reserves are reduced. And when it buys securities, their reserves go up. So imagine that the Fed is buying bonds from commercial banks. What that means is the Fed will take on securities, okay? So it's going to purchase the bonds from commercial banks. So the asset side is going to take a different form, but it's not actually going to change. They're going to lose securities, things, and they're going to gain reserves, money, but their amount of assets is identical. Okay, now where does the Fed get its money? It gets the money by just placing the money into the reserves of commercial banks. Okay, so that's kind of the thing. The Fed now has securities that it didn't have before, and its liabilities go down because the reserves go over here. So that's where the money comes from. It basically is simply created because it's all ones and zeros in the ledgers of the commercial banks. And this is what sort of matters. They used to have stuff, now they have money. Okay, and the Fed then has these securities that it used to not have. So when the Fed then sells bonds, what they're going to do is give securities, stuff, in exchange for reserves, money. Okay, so they used to have more cash, now they have more reserves. So why would they want to do this? Well, they want to do it in order to earn the interest on the securities, or if they had cash, that sort of thing. So how also would the Fed make banks buy securities? Well, the way that they would do it is by lowering the price of securities. So these securities that the Fed owns, they can sell at whatever price they want. It's always going to pay a fixed rate of interest, but you can take a $1,000 bond and you can sell it for $900, and then basically that person who purchased it is going to sort of immediately have that $100 change. Okay, so by lowering the price of the securities, they incentivize banks to buy them. And then that will decrease the money supply because that money is no longer available in banks to loan out. So let's see what it looks like. If the Fed buys a $1,000 bond from a commercial bank, okay, what that means they're going to do is they're going to take some new reserves. Okay, so this is money that they create, and they're going to, in exchange for a security, right? So the security goes up to the Fed, and the cash, the reserves, goes down to the bank. It all hits the excess reserves. And we're going to assume, again, that we still have that 0.2 MPS, which is what we've been using all through this unit as our assumption, which gives us a multiplier of 5. So all $1,000 goes into excess reserves because the bank knows that the Fed isn't going to come back for it, so it doesn't have to keep any reserves back. So 1,000 times the multiplier of 5 means that $5,000 is the amount by which the money supply increases. Now, it's a little bit different. The amount of money is the same, but the mechanism is a little bit different if we buy from the public. So, if the bonds are purchased not from a bank, but rather from people, that could be big pension funds, or it could be you. Probably it would be from some big bank or investment fund or something like that. But what they're going to do is buy that same bond for that same $1,000. You now have a check, and you deposit that check into the bank. Now the bank needs to hold on to 20% of it. Okay, so only 800 goes into excess reserves. So 800 times that same 5 gives us 4,000. But remember, the initial $1,000 deposit, that was also created. So 4,000 plus 1,000 gives us that same $5,000. So in the past, if the question is really concerned about how much is the money supply increased when the Fed buys $1,000 bond, it doesn't matter who they buy them from, but do be aware that the mechanism is slightly different. So instead of having excess reserves go up when it buys from a commercial bank directly by the whole $1,000 purchase, it's a little bit different. Purchasing from people, this $1,000 gets created and then it goes into the multiplier. Okay, the $1,000 here isn't actually created until it gets loaned out, and that's why the 1,000 doesn't get counted twice, right? All right. So now that's the main tool, open market operations, but there are others. The reserve ratio. So we were just talking about the 20%. If that went down to 10. Right, so then our multiplier would go, so we said at 20%, our multiplier equals 5. We get that by 1 over 0.2. But if we lower that to 10%, then that would be 1 over 0.1, which would give us a multiplier of 10. So by lessening the reserve ratio, the multiplier is different, so more money gets created when you lower the reserve ratio. This does not get used very much. The reserve ratios have remained constant pretty much for most of my lifetime, and certainly all of yours. Now the discount rate, the Fed can, and sometimes does, loan money directly to banks. So if they loan money at a cheaper rate, then banks would have a greater incentive to borrow from the Fed, which they could then pass that on as more lending to customers. This does not get used very much either. This is a small potatoes kind of thing. So you're not going to get a lot of questions about either one of these. But we know that the reserve ratio matters a whole bunch because it determines the multiplier. And there's always lots of questions about the multiplier. And, just today, as we're dealing with all of this stuff with the CARES Act and everything else, and the various monetary policy things that are going to come up. CARES Act, of course, is fiscal policy, but anything that the Fed is doing during this coronavirus problem is going to come up here too. Now, the term auction facility, it's in your textbook, but you can skip that section because it is not in use. So do not worry about the term auction facility. Okay, so this is basically what I just showed you on the last slide. You have a different multiplier when you're at different rates. So if you have a higher reserve ratio, then you get a smaller amount of money getting created. Here are reserve ratios. So this is, basically if you're a very tiny bank, you have a very low, and it goes all the way up to 10. Again, not very high. Okay, so tools of monetary policy. Open market operations is the big deal. So this is just a summary page. These three are the big three, okay? But this, of course, is the big of the big three. And this one is out. So ignore that in your textbook. Okay, now the federal funds rate is when you talk about interest rates going up and down, or when the Fed does something to change rates, et cetera, they're talking about the federal funds rate. It is the rate charged by banks on overnight loans. It is not the discount rate. This is what they are targeting when they buy and sell bonds. So the FOMC is targeting the federal funds rate by conducting open market operations in order to achieve the target. So when we say that interest rates are at 0, what that means is right now, because of the coronavirus, the Fed is targeting a rate between 0 and 0.25%. And they are buying and selling government securities in order to achieve this rate. It's obviously a range. It's very difficult to achieve an exact number, but they're basically keeping rates as low as they possibly can. So let's look at the demand curve for federal funds and then the supply curve for federal funds. So what we have is, a downsloping demand curve for federal funds. And when the federal funds rate is at 4, for example, now it's not, it's way down. It's way down here, at 0 to 0.25. But when it's at 4, it's going to intersect the downsloping demand curve for federal funds. And if those interest rates get lower, if it goes down by 0.5 point to 3.5, then you're going to demand a greater amount than when it's up here at 4. Likewise, if you raise it, then it would be, a smaller quantity of federal funds would come out. And we have this horizontal supply curve because let's say that something happens in the demand market. If the Fed has decided that it's going to target an interest rate of 4 and demand changes, then all you're going to have is a different quantity of loanable funds. You're not going to, the Fed will simply change the money supply. So instead of the money supply being vertical here, the money supply, they would create more money and the money supply would be here. That way, they're going to keep it at this 4% that they have tried to do. So the horizontal supply curve and the vertical supply curve, it's a confusing thing. What you have to understand is the Fed decides what they want the rate to be, and then they move the vertical supply of money curve right and left in order to, depending on where the demand curve for federal funds is, in order to make sure that that is the interest rate that happens. Thank you very much. Have a good day.